In case you haven't noticed, markets are going wild. And amid all this madness, many say that the classic 60-40 portfolio split of stocks and bonds is dead, and a new era has arrived. But is that true? In this video, we'll break down what 60-40 was built to do, why recent market shifts have shaken its foundations, and the arguments for alternatives to the classic portfolio split. My name is Guy, and if you care about your portfolio, then stay tuned to Coin Bureau Finance. Okay, now first up, I must make one thing clear. I am not a financial advisor, and nothing in this video should be considered financial advice. This is educational content meant to inform you about the 60-40 portfolio and how it stands in today's market. If that sounds good, hit that like button. And if this is the type of content you want to see more of, subscribe to the channel and ping that notification bell. So let's begin with the basics. What is the 60-40 portfolio? Well, it's essentially a simple split. 60% in stocks for growth, 40% in high-quality bonds for stability. It's the financial equivalent of a reliable family car. It's not flashy, but it gets you where you need to go with fewer breakdowns. There are many variations, but the idea is the same. Let stocks compound and let the bonds smoothen the ride. Why did this mix become the go-to? Well, because historically, bonds often behaved like a shock absorber when stocks took a hit. When equity struggled, bond prices tended to rise, and bond interest kept paying you to wait. That dynamic is what made 60-40 so popular with everyday savers and retirement plans. The blend aimed to grow wealth over time without demanding a high risk tolerance or an ironclad stomach. So, it's been the standard choice for millions of workers for a reason. Over long stretches, that somewhat boring blend has actually delivered great results. One piece of analysis from the Wall Street Journal using Morningstar data showed a plain 60-40 achieving 6.9% annualized returns from 2000 through to late 2025. That doesn't equate to mountains of wealth, but those compounded gains are certainly not pocket change, and they were achieved with far less drama than an all-stock allocation. Looking over a longer time frame, and the performance of 60-40 was all the more impressive. One study from Deutsche Bank showed a simple global 60-40 stock bond mix has delivered roughly 4.2% real returns per year over nearly 2 centuries. In other words, the classic 60-40 has consistently beaten inflation over very long horizons. So, what's actually inside the 60 and the 40? Well, for a lot of people, the stock side is just a broad index fund, something like the S&P 500 index. Meanwhile, the bond side is usually high-quality government and investment-grade corporate bonds. You can build it with 2 low-cost funds or buy a ready-made balanced fund that does the rebalancing for you. Now, that all sounds great and simple too, but there is a quick reality check. Stock and bond correlations aren't set in stone. There are periods when stocks and bonds move together for a while. That doesn't erase a century of solid performance, but it just reminds you that markets change. More on that in a bit though. Finally, investor behavior matters as much as the hard numbers. The best portfolio is one you can hold through cold sweats and hot takes. 60-40 has stuck around because it's simple enough for real people to hold without second-guessing themselves every time a headline screams sell, recession, or new paradigm. With 60-40, the split is set, you keep fees low, and you let compound returns do their thing. For everyday investors who just want something that compounds while they sleep, this has typically been what people mean when they use the term balanced portfolio. But what happens when a balanced portfolio isn't so balanced? Well, that brings us to the question of why many are now saying the 60-40 portfolio is dead. The spark that ignited this discussion came in 2022. That year, stocks fell hard, but bonds fell right alongside stocks. That combo almost never happens in a big way, and when it did, it caused a stir. Inflation spiked to 9.1% in June 2022, the hottest since the early 1980s. The Fed then slammed on the brakes with its fastest rate hike cycle since that era, and when rates jumped, existing bond prices dropped, so the safety part of the 60-40 split wasn't so safe. For bondholders, 2022 went down as the worst year on record, the precise year when your portfolio needed bonds to help. And for the classic mix itself, the 60-40 logged its worst performance since at least 1937. Ouch. Well, that settles it then. The 60-40 is dead because it performed poorly in a terrible 2022, right? Not quite. In 2023, the plain vanilla 60-40 staged a sharp rebound, returning about 17%. But just because it delivered gains doesn't mean it worked as intended. Those 2023 returns came largely because rates fell and risk appetite improved, and the stock-bond correlation stayed positive. Post-2022, equities and bonds tended to move in the same direction as inflation and rate expectations drove both. That turbocharged the snapback when yields eased, but it also meant weaker diversification, with drawdowns hitting both legs at once. Correlations stayed elevated through 2024 and have only begun to cool in 2025. The bond side has been temperamental this year. Long-dated treasury yields have swung sharply at times, so the 60-40's ride remains uneven, even as equities do their thing. Cooling correlation offers a possibility that things drift back to the old, reliably negative regime, but it's hardly guaranteed. Now, one thing we can't ignore in this discussion is the topic dominating market news recently: government debt. As government debt around the world is ballooning, there's increasing pressure for fiscal dominance to take over, if it hasn't already. To clarify, fiscal dominance is a world where budget maths pressures central banks to tolerate higher inflation. If that happens, bond yields can look attractive in nominal terms, certainly versus the recent zero interest rate era, but your real return gets eaten away. In the US, the cost of carrying government debt is already biting hard. The Congressional Budget Office projects net interest costs to exceed defense spending from 2025 through to 2035. For the US, this is alarming to say the least. So, the incentives for governments to quietly inflate away their debt problem via higher-for-longer inflation is extremely tempting. And to be frank, it would appear there is no other politically palatable option. Fiscal austerity just doesn't really fly in 2025. So, in this world, the fixed income side of a 60-40 split becomes considerably less attractive. On top of all this, there's also an incentive story behind the 60-40 is dead narrative. The 60-40 is cheap and commoditized. There isn't a lot of fee revenue in two broad index funds. Meanwhile, private markets and other alternatives can carry fatter fees. That doesn't make alternatives bad, but it may help explain why you hear so much marketing energy pushing you away from the classic 60-40 split. Now, none of this means bonds are uninvestable, but it does mean the idea that bonds always hedge stocks may no longer be true, at least to the extent it has been in the past. A new macro backdrop of massive deficits, heavy bond issuance, and higher-for-longer inflation makes the bond side more path-dependent than it's felt in recent times. The investors who shout 60-40 is dead are reacting to that shift. And to be fair, there is an argument for it, particularly as we find ourselves in a uniquely complicated macro situation. But whatever happens to the stock-bond correlation going forward, you can be sure there will be spells of volatility. And if you're looking to take advantage of all this volatility, then check out the Coin Bureau deals page. Over there, we have numerous finance-related deals and bonuses exclusively sourced for the viewers of this channel. To see them all, scan the QR code over here or click the link down in the description. They won't last forever though, so take advantage of them ASAP. Right, back to the video. Okay, so if there's reason to believe such a large allocation to bonds is holding back a 60-40 portfolio without offering sufficient protection, what's the alternative? How might one better diversify with that 40%? Well, some of the loudest voices are calling for commodities to enter the mix, primarily gold. Gold has arguably been the headline act in 2025, ripping to fresh highs as investors looked for safety in a messy macro mix of inflation concerns, tariffs, and geopolitics. Central bank demand remains a big tailwind. Official buyers snapped up over 1,000 tons of gold in 2024 alone, according to data collated by the World Gold Council. It's always nice knowing that a sizable allocation of your portfolio is supported by literally the most deep-pocketed long-term holders in the market. And if we look at the wider commodity basket, things are looking pretty solid there too. The Bloomberg Commodity Index is up this year, with precious and industrial metals doing the heavy lifting. For commodities, the diversification path is simple. Commodities often move in a different manner to other markets, which can be helpful for your portfolio when the market flip-flops between concerns about inflation and growth. But it's important to remember one trade-off here if we're cutting down bond exposure for things like gold. Commodities don't pay you income. Gold pays no coupon. Broad commodity funds can be volatile, and their returns can be impacted by underlying futures markets. So, commodities can surge like gold has recently, but can sag when the narrative cools. A similar case can be made for assets like Bitcoin, which is often given the commodity label. Access has become easier thanks to ETFs, and some investors are explicitly buying both gold and Bitcoin as alternatives to both stocks and bonds. But, needless to say, Bitcoin's volatility is in a different league to that of bonds, and correlations are moody. So, if you're using things like gold or Bitcoin or both as a total replacement for bonds in a portfolio, then you've changed that portfolio's structure closer to something resembling a bet. Now, that can work, but it just isn't the same concept as the classic 60-40 allocation. Next, a popular option being touted as an alternative allocation is real estate. Now, there are two very different animals here. Public real estate investment trusts, or REITs, you can trade intraday, and private real estate funds you typically can't. REITs are equity-like and rate-sensitive. When yields jump around, REITs can too, but the relationship isn't mechanical. The specific sector matters as well. Apartments and logistics can pass through rent growth faster than offices tied to long leases, and the commercial real estate reset has been brutal in places. But in contrast to commodities, income is a big draw here. Many REITs pay meaningful dividends, and over the long run, those payouts plus rent growth can be potent. However, it's important to remember that the path can be bumpy, to say the least, as the volatility looks a lot more like stocks than like bonds. Private real estate, meanwhile, has its own set of issues, primarily liquidity. In recent years, big non-traded funds hit their withdrawal gates when investors rushed for the exits, and some are still managing redemption backlogs or caps. So, needless to say, it's not exactly something you can count on as your safe, liquid 40%. So, if your goal for the 40 is income stability and a protective effect when stocks take a hit, then it's difficult or nigh impossible to find a clear replacement for the role bonds have played up until recently. However, there are some decent options out there if you're willing to take on more risk. Now, that doesn't mean you have to replace the whole 40% with a directional bet. For example, diversifying that 40% could also mean you end up with a split of 60% stocks, 30% bonds, and 10% gold. It's just important to be aware of how that adjustment changes your risk profile. So, there's a camp that says we should further diversify that 40% bond allocation in a 60-40 split. However, there are some who would actually argue to concentrate 100% into stocks or even 100% into bonds. Sounds crazy, right? Well, let's take a closer look. The 100% equities case is simple. Over long horizons, owning productive businesses has been a compounding machine, especially if we're set to have a generally looser monetary policy. This is one of the major arguments behind the debasement trade. You want to own assets that appreciate while governments inflate away their debt burden. But the catch is mental fortitude, discipline, and endurance. Bear markets can take half your portfolio and then ask for more. In the dot-com wipeout, the Nasdaq fell about 78% from the peak in March 2000 to the October 2002 low. So, if you can ride out that kind of drawdown without panic selling, then pure equity can make sense for truly long windows. Most people think they can until they meet a major bear market drawdown in the flesh and see their retirement funds shrink. Now, the 100% bonds or cash case is different, but just as clear. If you've got near-term spending needs, a low tolerance for big swings, or you're managing risk going into retirement, fixed income can be the choice. Even the world's most famous stock picker, Warren Buffett, has embraced fixed income when it serves the plan. Berkshire Hathaway has parked a record sum in T-bills and cash this year, a giant signal to opt for a heavy fixed income allocation from a legendary risk taker. But, as noted earlier, pure fixed income isn't a free lunch either. Bond coupons may feel safe, but over time, especially in a regime of fiscal dominance, real yields sag and your safe bucket quietly loses purchasing power. Go all bonds and you've traded one type of market drama for another kind of uncertainty. What the future path of policy and prices will do to your real return. So, which extreme wins? Well, that's the wrong question. The useful question is, which risks am I truly willing to live with for years? Concentration amplifies regret. For one person, the regret is watching stocks rip while they sit in cash. For someone else, it's seeing a 5-year plan derailed by a bad bear market. On that note, there's a reason retirement funds that have a split of stocks and bonds are often adjusted for the contributor's age. The younger you are, the more time you have. That means you can comfortably take more risks and should be heavier in stocks. The older you are, the more conservative you should probably be, and the greater bond allocation you should have. From one point of view, portfolio design is basically choosing your regret in advance and sticking to it. The practical play for most people most of the time is to pick a mix that delivers returns they can emotionally manage. And speaking of management, there's increasing pressure for everyday people to actively manage a portfolio of stocks in the face of a ripping market, especially if they subscribe to a 100% stock approach. But, as you've likely heard, over multi-year horizons, most active stock pickers lag comparable index funds. We're not saying you should never buy specific stocks, just be aware that you want to have a very good reason to think your stock pick can outperform the market in the long run. Now, although market participants are talking about all of these alternatives to the traditional 60-40 split, that doesn't mean it's going to fall out of favour altogether. So what might the future look like for people sticking to the 60-40 plan? Well, first and foremost, the next decade won't look like the zero-rate era of the 2010s. Starting yields are higher, and that's significant even if inflation is going to run higher than previous stretches, whether you're looking at the official numbers or your own index. But that tailwind doesn't make bonds bulletproof. Markets are still wrestling with inflation and deficits, and a recent Reuters poll suggests long-dated Treasury yields could stay stubbornly elevated even if the Fed trims at the short end. That results in conditions that can make bond prices choppy. Stock-bond relationships can also continue to change over time. When inflation is the dominant shock, prices can move together. When growth fears dominate, bonds could offer a hedge again. When it comes to stock performance going forward, we're in an interesting spot. With the market narrative dominated by the Magnificent Seven and AI, investors feel the clock is ticking and drift away from diversification to chasing what's running hot. But that has elevated the risk of a stock bubble. Many asset managers are urging cushions against an AI-led drawdown precisely because enthusiasm has clustered in a narrow group of winners. Concentration risk is real, and PE ratios are based on historical norms. So, although many have called for the death of 60-40, it's likely not a great idea to entirely abandon the idea of diversification and FOMO one way or the other. Granted, the stock-bond correlation is currently in question, but only slightly adjusting the 60-40 split likely yields better results than going all in gold or trying to become the next Warren Buffett. Now, it may seem like we're faced with a market that's impossible to navigate, but that is typically how markets feel. There's always something to worry about. So we'll reiterate Deutsche Bank's study from earlier, which showed that a 60-40 stock-bond mix delivered 4.2% real returns per year over nearly 200 years. That is to say, a 60-40 portfolio has consistently beaten inflation over very long horizons that included countless traumatic events and market regimes. So this may be a rough patch for the 60-40 split, but veering too far away from this proven approach may prove difficult. Okay, and that's about it for today's video, but what do you think? Is the 60-40 approach dead for good? Are bonds toast? Let us know your thoughts down in the comments. And if you want to learn more about macro topics like the state of the Eurozone, for example, you can check out our video on that right over here. As always, thank you for watching, and I'll see you again soon. This is Guy, over and out.